Welcome back to Markets Today. I'm your host, Mbithe Mwema. If you are just joining us, I'd encourage you to actually go back to our website and actually watch what we were discussing earlier. We had an interesting overview of what was happening on the NSE last week. We talked about turnover, we talked about the top gainers, the top losers. We also captured the market sentiment and what we expect to happen during this week. For this particular segment, I am joined by Mr. Martin Mwerigi. He is a senior equity analyst at Standard Investment Bank. We want to discuss the bank results, what is happening there, and what should we be looking out for in the future. Welcome to the show, Mr. Mwerigi.
Thank you, Vida. Thank you for having me.
All right. So the banks have been reporting numbers, not very exciting numbers. Give us an overview. What are we seeing? What's happening this season around?
I think most investors had an idea that things will be bad. It was just a matter of how bad will things be. And we saw the first lender being KCB, profits down over 40%. And the theme is all one thing. The theme that in Q2, theme was all based on cost of risk. That is, how big will the impairment cost be? Investors, I think when the first lender released results, we saw some jitters, especially on most of the bank stocks. However, towards the tail end, it's as if that investors took it in stride. We don't expect any dividends, which is what the chorus have been singing all along since April this year.
Yes.
So I think right now investors have a feel of what to expect in the second half. Yes.
Okay, so cost of risk, loan loss provisions. What does this really mean? Just break it down for us.
So a lender has to anytime you lend a loan under IFRS 9, let me take it a step back. We had IAS 39 that expired, for lack of a better word, and IFRS 9 came in place from 1st January of 2018. So the idea is anytime a lender lends, issues a loan facility, it could be even an overdraft, any facility, for instance, you need to take a cut, you need to provide for the likelihood that client or obligor is unable to pay. So come COVID-19 in tail end of Q1, Q2 we saw elevated cost of risk. Those clients who are not able to pay, we've seen a lot of industries going, I don't use bust, but
yes.
Very challenging environment. The macros have been really tough. Personal consumer, most people have been laid off, unfortunately. So the cost of risk has indeed increased. So a bank needs to go ahead and provide for the likelihood of default that these lenders might not, these borrowers might not be able to pay.
Okay. So
CBK came forward and allowed banks to restructure loans that were performing from 2nd of March. The window already closed. I think the window closed in end of June. So banks took advantage of that and restructured loans. Clients were being told come forward. Some banks went ahead and just looked at a whole industry or a sector perspective, and they restructured those facilities based on how they are performing and how the macros are looking at the moment. Yes.
Okay, so COVID-19 pandemic, the onset of that actually required the banks to be extremely vigilant and more prudent. So the cost of risk had increased just to reflect the kind of uncertainty that we were working on.
Precisely.
Now, before I go into the specific banks, this cost of risk, has that environment changed? Are we in a more certain environment now that we are getting into September, the month of August is over? What's your sense of this cost of risk? How does it continue in the coming months?
I think the scenario is pretty fluid still. Equity Bank's conference call, they said that, and I concur on this, they said the things, we had a bottoming out effect around May of this year. And some sectors, there are some pockets of sectors that are starting to rebound. I always look at how the economic activity is, how the macros are currently in play by just taking a drive in the evening or in the morning, how the traffic is.
Yes.
If you've noticed right now, we are almost going back to your full traffic gridlock that
Okay,
used to
so
be.
we're sort of going back,
We're
with
sort
the
of going
exception of the
back.
government of Kenya activities, because they're still on lockdown for another 30 days, give or take.
Precisely, but also some sectors, some sectors still haven't bounced back.
Okay.
Tourism, you're seeing bouncing back, especially from a local tourism perspective. However, hospitality, you're seeing now restaurants, most of them are still operating at not full capacity. Now we have ban on alcohol sale.
All right, so a couple of things
A
going.
couple of things still going.
Okay,
on,
fantastic.
yes.
Now, this is more of a conversation of a deep dive. We can ask our graphics team to put up the numbers for KCB. So you're saying these numbers are down 40% because of the cost of risk. So help us understand the core operations vis-a-vis the operations, including the uncertainty in the market. What was happening there?
So KCB, from a year-on-year perspective, and if you remember, I'll take viewers back to the acquisition that happened with NBK. That was consummated in Q4 of last year. So if you want a like-for-like comparison, we went ahead and added up the group, the KCB group vis-a-vis plus the NBK group as at first half of 2019, and then
so
compared with
you
these
compare
years,
the like for like.
like
Okay.
for like.
Okay.
So it's down 41%, not just the 40%. That is the bottom line. That is the EPS. However, the operating profit is up 12.3%, which is very solid. That shows you that. That's one thing I think investors need to take a very keen eye on. If just removing provision, removing the cost of risk out of play, how is the business itself running?
Okay.
So you can see it's a pretty well-oiled machine.
Business. So up
Yes.
12%, excluding the uncertainty that has to be taken into cognition by the managers of the company. Okay. So now it's trading at 36.45. Is there still more value at the table? I know we saw it come all the way to 30. I missed it as well there. I just thought it would go lower. 36.45. Is there value on the table?
I am hold. I am unfortunately
you're a
I'm
holder.
holder.
Okay.
I'm holder simply because I think the fluidity of the situation is still at play.
Okay.
Cost of risk, they're still expecting north of 4%, which will still be high, which will hit their bottom line. The question is, will we be back come early next year? Will we be now going back full throttle? And honestly, if we are, and I think the next 2, 3, 4 months will tell us how next year will look like. So we'll see that banks will basically be operating. Come reporting next year will be off a lower base. Hence, I think we'll have some really good value going forward.
All right.
So it's all about, for now it's a hold.
For now,
me.
so hold it. If it comes
Hold it.
lower, maybe
If it comes back,
consider.
get in. Yeah.
Okay, but I don't see
But
it
I
coming
don't
back
see
to
it coming
30.
back.
I
I'm
think
not
that
seeing- I'm
boat
not seeing
sailed,
that.
right?
It's something as Equity Bank. I'm not seeing
Equity
that
Bank.
thing.
All right. Our graphics team will put up the numbers for Equity Bank as well. So there was also similar trajectory, but not to the extent of the KCB numbers. What was happening with the Equity Bank numbers?
Equity, I think Equity is, we released a report early July where we say that Equity Bank will be the hardest hit, especially due to its exposure in the SME space. So, and we saw that in their cost of risk was still high, 4.2%.
Okay.
And they expect that trajectory to actually proceed in the second quarter. Just to show you how exposed they are, they're saying they have restructured 45% of their book. That shows you how challenging for them it is going to be. So it's all a matter of how soon will we get back to normal business, for lack of a better word.
Okay. Martin, 45% of the book is restructured.
Yeah.
So does this mean this double-digit drop in earnings could be the same trend at the full year?
Remember, they're accruing their interest.
Okay. Oh, they are.
Yeah, exactly.
Is that something that's
So it's
cutting
just-
across
it's-
the industry?
Precisely.
Okay.
So a bank is going ahead, which is a bit smart if you look at it from that perspective.
Yes.
You restructure that debt, but still, because you have not forgiven the client the interest, so still accruing the interest. You're just taking the hit on the bottom line by now the cost of risk. But here, the cost of risk you're going ahead and doing, it's the general provision, not the specific provision.
All right.
Because if the loan now migrates to non-performing, now
Then-
you'll have to suspend the interest at the
Okay,
top.
okay.
And not only that, you'll still have now to take specific provisions which are higher than your general provisions. Yes.
All right. So what I hear you saying, Martin, is the window that central bank extended to the banks, which was
Around 3 months.
3
yeah.
months to restructure, is if you actually restructured, I'd come to you as a client and say, if you're unable to pay, why don't we either lengthen it or reduce your principal and interest repayment on a monthly basis? But you still had to continue paying interest, even as you were getting into the conversation of restructuring.
So different banks are doing it differently. Some are giving, because they're noticing there's some clients who have cash flow issues. Give you a good example. Look at private schools right now. The school is still performing very well. Even if you tell them right now pay interest, where they're going to get the cash flow at the moment.
Exactly.
So some are doing giving holidays for both principal and interest, depending on sector specific and client specific.
Okay.
But they're accruing the interest, because they're not pushing away. They're not saying that we're forgiving you the interest. So they're still accruing it.
Okay, so it accrues in their books, but then you can pay at a later date.
You'll still pay at a later date.
So, all right. What is this in terms of accounting then?
Accrual-based accounting.
Accrual-based accounting.
Yes.
So, accrual-based accounting is a key thing we're hearing from you.
Yeah.
Credit risk is
Yes.
also another key thing that we're hearing from you. So, in one way, you're saying there's cost of risk is increasing, certainly because of the uncertainty. But somehow the banks have been able to restructure and, using the accrual form of accounting, accrue interest, which is really what is supporting their core operations.
Absolutely. So the question now becomes, the million-dollar question becomes, what about cash flow?
Exactly.
Because now it's going to be like, okay, clients are not paying back your loans because you've restructured, you've given them holidays, but you're still accruing. But what about your cash flow? So banks that are being prudent with regards to their treasury operations, how they manage their cash flow, will find it robust going forward. The good thing is that the regulator already, that is the CBK, already foresaw that. And if you remember the first MPC in April, we had they extended, they came up with a reverse repo. They waited for 91 days.
Yes.
They foresaw that thing happening. We saw last week, actually, the CBK was in the market for reverse repos. That shows you that liquidity is starting to contract, which I think will gather pace and momentum come tail end of that is September. We should be seeing liquidity drying up.
But central bank has sucked it all in through the infrastructure bond.
Yeah, no, that's the other thing. You've sucked through the IFB.
Yes.
Early this month, you still did a tap sale.
Yes.
Last month, you did actually 3 bonds. You offered 3 bonds at the primary. Okay. So
you're sort of just taking it all.
you're taking it all anyway. And then they're also in the market for TADs. However, we can say TADs is cyclical, so the money will still mature and come in within less than a week. That's a different story. But the other thing about liquidity is I saw last week an article saying that pension fund, that is employers have not remitted to pension funds around 1.2 B. If it's 1.2, it's 2.1 billion from the RBA.
Wow.
That's RBA. Because RBA gave a moratorium.
Oh, yes, it did
for
give a
employers.
moratorium.
Yeah, because it's all
That's
about
very
cash flow.
true.
You want to make sure.
Okay.
So that is cash flow that will have gone to fund managers,
Yes.
hence being in the banking system and whatnot. So we should see contraction of that liquidity, especially if the government doesn't release it in good time.
So if this liquidity tightens and these banks have not been lending,
Yeah.
will they lend? Because from the numbers that we saw, we have seen double-digit growth on deposits.
Yes.
Are they going to lend, or will they keep giving it to the government?
Now, the key thing here, they will play defense, which I think if you notice how the loan to assets ratio started going down to around, right now it's almost 50-55%. Most banks are adopting defense, which makes sense anyway. So liquidity, they'll play defense based on 2 things. You don't want to lend because the environment is very uncertain and whatnot. Secondly, you also want to have enough liquidity in your balance sheet to support any liquidity needs that will arise. And then thirdly, and most importantly, the appetite for the treasury with regards to domestic debt is humongous. We need around 494 billion in
Just to
in net
finance.
domestic borrowing this year.
Okay,
as
that's a
is.
lot of money.
That's a lot of money.
money.
Yeah.
It's considerably
That's
higher
net.
than last year. Last year was about
Exactly.
300, 350.
Yes.
Okay, fair
And this
enough.
is net.
Okay.
So we have not looked at the gross amount. Yeah.
Okay.
Yeah.
We'll take a short break, Martin. When we come back, we will look at the highlights for Cooperative Bank, Diamond Trust Bank, as well as Standard Chartered Bank. But really what we are hearing is, fair enough, the numbers don't look good, but they don't look good because of the cost of risk. The bank managers have been in a spot where they have to provide because of the uncertainty that has been brought forth by the COVID-19 pandemic. The other thing that we've heard from Matt, which is quite interesting, is the banks have been slightly smarter. I mean, as expected, they have to be the smarter people in the room, is they are using the accruals basis for accounting to accrue interest. In other words, Martin is telling us, be cautious of the top line and the middle line. It might look good, but there could be some question marks and some possible pain to come in the coming months. We take a quick break. When we come back, we will be discussing the other three banks and then tying up this conversation to say, should you then be buying the banks? Should you hold the banks? Should you even consider selling some of these banking stocks at the current price points? Remember, we want to hear anything that you want to ask us on banks. Where are you watching us from? Who are you, if nothing else? And what would you like us to be able to address for the coming session? Let me know all of this. You can either reach out to me directly, that's Mbithe Mwema on social media, or you could reach out to Metropole TV on all social media outlets. Let us know what your questions are. We will answer this tomorrow during the Ask Mbithe segment, which is a segment where we just tap it down everything, and we are literally here for you to answer all your investment questions. We take a break. See you in a few.